On a late summer evening in 2014, two titans in the Silicon Valley tech industry sat down to play a high-stakes game of poker. But the outcome of the game itself was largely irrelevant, because the two players, Mark Zuckerberg, founder and CEO of Facebook, and Jan Koum, co-founder of WhatsApp, were really there to negotiate the terms of Facebook's acquisition of WhatsApp. At a price of $19 billion, the deal became what was then the largest ever for a venture-backed company, and stood to solidify Facebook's grip over the social media market. But to many outsiders, the deal just didn't make economic sense. After all, WhatsApp was still a relatively young company that only had 50 employees and earned a mere $10 million in revenue in 2013. But to make matters even more precarious, Facebook opted to finance its $19 billion purchase in large part using its own stock, which at the time amounted to about 10% of Facebook's market cap, and based on today's valuation, puts the final deal price at around $50 billion. So for today's video, I wanted to revisit the seemingly questionable acquisition to get a better understanding of why Facebook was so eager to buy WhatsApp back in 2014 and decide for ourselves whether the company was justified in paying such a hefty fee. The first decade of the 21st century in the telecoms industry was characterized by the rise of text messaging. Prior to 2010, if a cell phone user wanted to communicate with another cell phone user via text, they sent something called a short messaging service, also known as an SMS. Using SMS, messages were sent from one phone to another phone via a carrier's network, limited only by the quality of cell phone reception and the number of texts allotted to the phone under the cell phone plan its owner paid for. And in an era of razor flip phones and sidekicks with full keyboards, SMS messaging became incredibly popular. In the United States alone, the total number of text messages sent grew from 81 billion in 2005 to a peak of 2.3 trillion by 2011. However, in the years that followed, the popularity of SMS messaging slowed significantly, dropping 35% to 1.5 trillion messages by 2017. And this was largely attributed to the rise of instant messaging. Instant messaging, or IM for short, sent text messages via the internet, using either Wi-Fi or connecting to the internet using a carrier's data plan when no Wi-Fi was available. So by the turn of the decade, companies like WhatsApp, WeChat, Kik Messenger, and Viber began offering sleek instant messaging platforms that slowly shifted consumer preferences away from SMS messaging towards instant messaging. And as a result, by 2013, instant messaging officially overtook SMS messaging as a predominant form of mobile chat, with over 10 trillion messages sent globally, compared to 6.2 trillion sent via SMS messaging, going on to reach 25 trillion by 2016. And within the instant messaging market, WhatsApp stood out as one of the predominant platforms. Founded in 2009 by former Yahoo employees Jan Koum and Brian Acton, the platform focused on perfecting the basics, with minimal intrusion into users' lives, opting not to serve ads or offering games like many competitors did at the time. In fact, in a blog post by Jim Goetz, a partner at Sequoia Capital, which was WhatsApp's sole VC investor, he referenced a post-it note that was taped to one of the co-founders' computers, stating, "No ads, no games, no gimmicks," as a constant reminder of this mission. But in a market where ads filled up the majority of users' screens when trying to chat with their friends, WhatsApp stood out from its competitors for its hatred of the conventional advertising model, with one of the co-founders calling ads an insult to users' intelligence in a 2012 blog post. And consumers seem to really resonate with this approach to messaging, because WhatsApp's user base exploded, pushing the platform to become the most popular messaging service by 2014, with over 400 million users. In fact, WhatsApp became the fastest growing company in history based on monthly active users, which we can see if we compare WhatsApp's user growth to other social media services like Facebook, Gmail, Twitter, and Skype. Here we can see that by WhatsApp's fourth year, it had nearly triple the number of users that the second fastest growing platform, Facebook, had by its fourth year. And around this time by 2014, Facebook was 2 years post its IPO and was beginning to hit its stride as a publicly listed company, with strong user growth as Facebook reached 1.4 billion users by 2014. But even more enticing was the engagement of these users, because compared to competing social media platforms, Facebook users were by far the most engaged, with 70% of users reporting to use the site daily. In comparison, only 36% of Twitter users, 17% of Pinterest users, and 13% of LinkedIn users reported accessing these sites daily. But Facebook's corporate strategy wasn't only focused on organic growth. Only a couple years prior, in 2012, Facebook had acquired Instagram for $1 billion. And by December of 2014, only 2 years after the $1 billion acquisition of Instagram was completed, analysts suggested that due to its explosive growth for Facebook, Instagram was now worth $35 billion, and was positioned to contribute over $2 billion to Facebook's annual revenue in 2015. And all this success combined was immensely rewarded by public market investors, as Facebook's stock was outperforming the greater market by a significant margin by 2014. So hot on the heels of this recent success, Facebook announced it had reached an agreement with the founders of WhatsApp to acquire the company in February of 2014 for a price of $16 billion, $4 billion in cash and the remaining $12 billion in Facebook shares. But in order to ensure that WhatsApp's 50 employees stayed with the company following its acquisition, Facebook ended up adding an additional $3.6 billion to the deal. And by the time the deal officially closed following regulatory approval in October, the value of Facebook's shares had soared from $68 to $77, meaning the agreed upon 184 million Facebook shares that made up the stock portion of the deal inflated the price even more, bringing the final acquisition price to $21.8 billion. But at such a high price, the deal seemed simply untenable to most industry observers. One of the reasons that Facebook's acquisition of WhatsApp confused many industry observers was the lack of complementarity between the two businesses. WhatsApp's approach to messaging centered around minimal intrusion into their users' lives. The company prided itself on the fact that the service only required users to provide their phone numbers and didn't collect personal information like their user's name, gender, age, etc. But this obviously was in stark contrast to Facebook's advertising model, because Facebook's business model depended on the platform collecting as much personal information about its users as possible so they could serve more relevant ads and charge higher ad rates. And with Facebook's promise to keep WhatsApp as an independent entity, separate from Facebook's other offerings, there wasn't really a clear path to monetize the acquisition from Facebook's perspective. But putting aside the lack of business model complementarity between the two companies, many argued that Facebook didn't need to purchase a messaging app because it already had Facebook Messenger. Alongside the shift to instant messaging from SMS messaging that we discussed earlier, consumers were shifting towards mobile consumption of social media using smartphones. And this was clearly reflected in the changing composition of traffic sources used to access Facebook prior to the acquisition of WhatsApp. Because in the second quarter of 2011, Facebook users who accessed the platform solely from their desktop made up more than half of monthly active users. But by the second quarter of 2014, that figure dropped to 19%, with 50% of users accessing the platform through a combination of desktop and mobile, and the remaining 31% of users accessing the site only through mobile means. And this shift towards mobile consumption of Facebook was largely facilitated by Facebook's introduction of Facebook Messenger in 2011, which was a standalone mobile messaging app to compete with the instant messaging platforms that we discussed earlier. And Facebook Messenger turned out to be a huge success and held up pretty well against competing social messaging apps. In the US alone, nearly half of all smartphone users used Facebook Messenger, compared to WhatsApp, which was used by about 35% of the population, and Twitter, which was used by only a quarter of Americans. But Facebook Messenger aside, even if, for whatever reason, Facebook was so infatuated with WhatsApp, it wouldn't have required a significant time investment to recreate, and most certainly could have been done at a cheaper price point than the nearly $22 billion it cost Facebook to buy WhatsApp. But even though WhatsApp and Facebook weren't exactly complementary to one another's business model, perhaps the deal just made sense financially. After all, any business can be an attractive investment at the right price, relative to the cash flow it produces. So to evaluate this possibility, we can take a look at WhatsApp's financial performance around the time of its acquisition. WhatsApp kept its business model simple. The app was free to use for the first year, after which users paid a subscription fee of 99 cents annually to keep using it. But many suspected that this decision would limit the business model's ability to generate revenue, relative to the more traditional advertising model. And these suspicions were later proven when Facebook first reported the accounting behind WhatsApp, which showed that the company had a limited path to profitability, having lost around $55 million in 2012 and around $140 million in 2013. But in WhatsApp's defense, an early-stage startup losing millions of dollars is nothing new in Silicon Valley. So maybe we should take a different approach to judge the valuation that Facebook paid in this acquisition. One such alternative approach would be to compare the deal to similar acquisitions that were made around the same time period. One example would be the 2014 acquisition of Viber by the Japanese internet giant Rakuten for $900 million, which had 100 million monthly active users, implying a price of $9 per user. A second example that same year in 2014 was the acquisition of South Korean messaging platform Kakao, which had 150 million users and was bought for $3 billion, which implies a price of $20 per user. But the WhatsApp acquisition beats both of these pretty easily, because at the time of the deal, WhatsApp had 500 million active users, which implies that Facebook paid $42 per user. And at that price per user, Facebook paid more than double what was paid under the Kakao acquisition, and more than quadruple what was paid as part of the Viber acquisition. So at this point, it's pretty tough to argue that Facebook didn't significantly overpay in acquiring WhatsApp. But this deal is a fantastic example of why viewing acquisitions solely through the lens of financial valuation or analysis of business model compatibility might be short-sighted and lead us to miss the true value in an acquisition. Because I would argue that this acquisition was more of a defensive move. Facebook undoubtedly recognized that WhatsApp posed a long-term threat to Facebook, since both companies were focused on improving communication and connecting people around the world. But what was likely even more concerning to Facebook was the fact that the instant messaging space was slowly morphing into the newest battleground amongst the big tech players. After all, Apple had launched iMessage in 2011, and BlackBerry's BBM was beginning to develop into an instant messaging platform of its own. So Facebook likely thought to themselves, if we don't buy them, then one of our competitors might. And these fears turned out to be valid, because it was later revealed that Google had made its own bid of $10 billion for WhatsApp, and both Microsoft and Tencent, the company behind WeChat, were reportedly in the midst of preparing their own bids for the company. And the prospect of greater competition from these tech giants wasn't too enticing from Facebook's perspective. After all, Facebook had a pretty poor history when it came to organic growth, and competing on level ground in the open market. Many people often forget that when Snapchat first started gaining momentum among consumers, Facebook tried to make an exact copy of the service in 2012, which it called Poke. But that ultimately flopped and was unable to overtake Snapchat. And by that time, it was too late, because when Facebook subsequently offered to purchase Snapchat for $3 billion in the fall of 2013, they were flatly rejected. And we all know how that worked out for Snapchat, as it went on to IPO shortly thereafter at a $24 billion valuation. So when WhatsApp came around in 2014, Facebook clearly learned its lesson, recognizing that they couldn't repeat the same mistakes they had made with Snapchat, or even worse, allow it to fall into the hands of its competitors. So instead of waiting for the real bidding to get started, they opted to swoop in and woo the founders of WhatsApp with what seemed like a completely ridiculous offer, hoping to lock up the company before any of the other tech giants were able to submit their own offers. But this becomes even more evident when we take a look at the 8K filing that Facebook made as part of its acquisition of WhatsApp. 8K filings are reports issued by public companies of unscheduled events that are materially significant and therefore require disclosure to public market investors, like the resignation of influential directors, bankruptcies, or in Facebook's case, an acquisition. And as part of this filing, Facebook reported something accountants call goodwill, which is the intangible assets associated with the purchase of a company when its purchase price is higher than its net fair value. And in this case, Facebook valued WhatsApp's goodwill at $18.1 billion, which would suggest that they only valued WhatsApp's core business at $3.7 billion, only 17% of the price paid to acquire the entire business. But in retrospect, from Facebook's perspective, paying that $18.1 billion in goodwill seems like a pretty cunning way of eliminating what would have been a worthy competitor in the social media market. But with that said, let me know what you guys think about Facebook's acquisition of WhatsApp. Do you think Facebook made the right move in acquiring WhatsApp, despite its $22 billion price tag? And how do you think the tech industry might be different today if Facebook hadn't acquired WhatsApp? And what other tech giant do you think would have been more suited to acquire WhatsApp? Let me know what you think in the comments down below.